Hi, welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not investment advice, however, so please check the disclaimer in the show notes. And in this episode, we are digging into portfolio benchmarking within the family office.
This is the Family Office Sherpa.
To get it out of the way, I love benchmarking. As an part of an index manager in State Street Global Advisors, I'm particularly interested in the way that people can benchmark against asset management, internal and external, and at the asset class level and total return. So, as someone who works with clients on investment governance, one of the hardest things to do is to measure that efficacy. That is, are we and our internal and external resources do their job? And now it's got to be remembered, though, we're not just about measuring some external benchmarks such as MSCI or Standard & Poor's, because family offices are not managing money for external parties. Their measures should be about matching their own goals, so specific and unique to them as the family themselves and the assets that we're managing for. In my mind, there needs to be an appropriate measure for financial and non-financial goals. Non-financial goals meaning outcomes that are more qualitative, such as happiness within the office structure. So how everyone's coming into the office, how is everyone finding it of value? Are the relationships within the office beneficial? Are we getting value from them? And these can be determined by, let's face it, just listening to people and talking to people normally, or if you're after data points and things like that, then surveys are an effective tool for that. Now, financial benchmarks are what we're talking about today. They're can be more defined, but they are absolutely no less unique to that office. And I'm going to be speaking about those today. So what are we talking about? So for me, benchmarks represent a chance for the office to measure the investment portfolio against our goals. This could be as straightforward as matching the state of return in the investment policy statements, which we've covered before. And that may be something like a total return, like a CPI benchmark or something similar, or it may be getting deeper into the weeds of the individual asset classes. What it comes down to is, like I said, measuring the efficacy of a really unique style of investment or a style of client. So let's break it down. So total return first. Most clients that I have or engage with use a consumer price plus style benchmark, one that takes into consideration inflation for their total return, because it's looking at the ability for the portfolio to outpace inflation, basically. I've also seen cash plus, which is, within this higher rate environment, can be really impactful and can be a good benchmark. And to a certain degree, I guess, compares us to a version of a risk-free rate, i.e. what we get for taking on little to no risk at the cash rate or something similar. Now, recently, outperforming inflation, as you all probably know, has been a little bit harder in the previous years, in particular, like I said, a higher rate environment. So I guess what it does do is it serves as a good reminder that we need to use a time frame of a certain length that smooths out these fluctuations and makes it meaningful, not just for the office, but also for those looking at what they should be targeting. The other thing that we're seeing a lot as well is investable benchmarks. As I said, I came from SSGA and I used to head up the SPDR ETF business. So I'm a big fan of saying, well, what's one of the best gauges of success is to compare the portfolio or the asset class or the portfolio in aggregate or at the asset class level to a return in either in a multi-asset portfolio, like a passive balance fund. I've seen clients use a passive balance fund that publishes a daily NAV, and we can compare that really, really effectively and really easily in really simple reporting. The challenge, I guess, with most of these things is it lacks the nuance of a tailored portfolio, because it's the whole point of these passive balance funds is that it's supposed to be as attractive to a risk profile, but a broad risk profile, not the specifics of a family office, which can be really quite idiosyncratic. So it doesn't take into consideration that nuanced, tailored portfolio. But what it does show you is that what level of return you would have received at a similar risk profile. So balanced growth, high growth, something like that, net of fees. So, showing it's not always reflective, but it does show you a very good comparison. And also now we look at the asset class specific benchmarks. For most asset classes, there are industry standard indexes to use. For example, in Australia, we use the ASX 200 accumulation benchmark, that compares our local equity investments. Where it gets tricky, though, is for those assets that don't have that published equivalent. Or the ones that are available but may not be appropriate to the way the office invests, particularly in that asset class. So again, you're coming back to that sort of horses for courses piece. What we're really looking for is what a lot of people call compensation for risk. Right? So how we measure something, and then what's the margin for that risk, or extra risk that we're taking on. So it's about the expected return on investments that have been noted in investment policy. If we expect to get compensation for illiquid investments versus public, so going into private equity, say, as opposed to, like I said, the ASX 200 ETF or similar, then this can be represented, and I have seen this a bit, which is, say, a public market plus an expected margin. That may be 2%, 3% above that public market. So really what we're looking to do is to benchmark on the expected margin to reward that risk that we're taking. I've also seen clients use more relevant public benchmarks, such as, there is talk of, if you're going into private equity, so what's the step above private equity? It might be small caps. So like some sort of small cap benchmark. And then you can use that as a better proxy for small caps plus the margin for liquidity. We're starting to see that a little bit as well. The challenge for a lot of families is the standard of benchmark may not actually look anything like your investment, or the standard benchmark may not look anything like it. And therefore, it doesn't have any correlation with your investment. So what's the point? What are you trying to measure here? So I think it always comes back to that. What are we trying to measure? And if we can't find a benchmark that looks like our underlying constituents or looks like the way we invest, then it might not be appropriate. So I guess it's always that tricky, looking at what the underlying index is made of, what that underlying index constituent makeup, how the index provider actually produces that index. And this brings us back to the notion that any measure needs to be relevant for the family itself. Right? So it's up to you as the family, or up to you as the advisor of the family, to say, does this reflect the reasons for investing in that particular asset class? And as mentioned, the family office superpower is patient capital, right? And therefore there is a need to be patient with the benchmarking too. Don't get caught up in chasing returns and chasing benchmarks or chasing investable versions that are not reflective of the way that you're looking to invest. A few things to remember. Communicating the intent of these benchmarks to family members is paramount. If you do expect to get tracking error relative to a benchmark, then you need to keep making that point in every set of papers or every investment committee meeting where those numbers are reported. So again, this is why it's so important to get the right benchmark. But also, if you can have a proxy, but it might be underperforming or outperforming, then you've got to, the family or the people looking at the report need to understand why. Also, you don't have to take your fund manager benchmark. I see this a lot, right? Which is, I'm a big proponent of establishing high quality investment reporting. And one of the benefits of that is the fact that you can do your own internal checks. You can do your own internal composite benchmarks. You might, like I said before, when you're talking about, small caps plus a margin, or maybe it's, a couple of different factor-based ETFs or something like that. So one simple example is, say, to use a factor-based benchmark where the fund manager might be giving you a cap-weighted benchmark, because that factor-based benchmark lets you use quality. So quality is often, an active manager kind of selected benchmark, which is it's low leverage. They're looking for stocks with high return on equity and stable earnings. I mean, who isn't, right? So if you could have a factor-based benchmark that really tries to bias towards those low leverage, high return on equity, stable earnings stock, then that's a better benchmark than a cap-weighted benchmark or something similar. So that's a really good way of looking at it. These are my managers, or this is the manager we've selected. Are we benchmarking it against an index that actually looks like a passive version of it, like a recipe? So that's something that I've seen. That's something that I would, I'd like to see when people have their benchmarking in place. And, because not to say that all of them do it, but some fund managers will pick a benchmark or change a benchmark that makes their investment look better over periods of time. So use your own benchmark. It's your money. It's your investment. Benchmark it how you want. The way I would also think about it was to is what do you want to achieve from each asset class and over what period, and what would success look like, right? I think that's ultimately what we're getting down to here. What would success look like for each of those asset classes and in aggregate, and explain that to the family. Either have it in the investment policy or really start to use it in the investment committee meetings. This may lead to periods where the actual performance is very different to the benchmark, but you just got to remember, what does success look like over the period of time? So that's it. Thanks for listening. Hopefully you found it of interest. You can find me on LinkedIn. And if you're looking for more family office information, subscribe to the Sherpa newsletter, which comes out every 2 weeks at wholroad.com.au. That's HALLROAD.com.au. You can find it super easy to register there. If you're a family office and interested in learning more about how I assist with investment governance as an investment committee member or an advisor to them, feel free to email me at Shaun, it's SHAUN, at wholroad.com.au. Until next time, thanks for listening.